Ichimoku cloud is mentioned to be the king of indicators, and with good reason, because with Ichimoku, it's possible to get the whole picture of the price, including trend direction, the main support and resistance levels, and exact entry and exit points. Ichimoku can be used in many ways. It can be used as a standalone system, or it can be used as a trend and price confirmation, and can be combined with any trading systems or strategies. Today I'm showing you how to use it correctly and how to perform a multiple time frame analysis using the cloud. And if you want to show your support, please leave a like to help us with YouTube algorithm and turn on the bell so you don't miss when new videos are released. Ichimoku indicator has 5 lines: the conversion line with the default settings of 9 periods, the baseline with default settings of 26 periods, the lagging span with default settings of 26 periods, and the 2 lines forming the cloud, faster span A and faster span B. When you use the Ichimoku indicator as a charting system, you don't aim to get precise entry and exit signals. You want to get important information about the market, for example the trend direction and the main support and resistance levels. And while identifying a trend in the beginning of it is one of the hardest tasks for a trader, this indicator will help you a lot. This is how you easily find trends with Ichimoku indicator. First, by analyzing the Kumo. To identify the trend, you first analyze this component on its own and versus the other components and the price. So number 1, the color of the Kumo. If span A is above span B, the color of the Kumo is green, and it indicates a possible bullish trend. If span A is below span B, the Kumo color is red, and the trend is indicated as bearish. When span A crosses span B, the color of the Kumo changes, and it warns about a possible trend change. Number 2, the thickness of the Kumo. The thicker the Kumo, the stronger the trend is. A significant Kumo means a strong trend, and a tiny Kumo indicates a weak trend, as it's more easy for the price to move through a thin cloud than a thick one. However, it's important to keep in mind that the top and the bottom of the Kumo are support and resistance lines, so even a thin Kumo can turn the price back to its previous direction, however the chances are lower. Number 3, the Kumo versus price. One of the most basic fundamentals of Ichimoku is, if the price is above the Kumo, the trend is bullish, and if the price is below the Kumo, the trend is bearish. It's very visible and easy to determine if the overall trend is bullish or bearish with this method. Every trend begins with a Kumo breakout, when price breaks out from the Kumo cloud on the upside or on the downside. When price is moving inside the body of the cloud, the trend is not present. Number 4, the Kumo versus the lagging span. Lagging span can be above the Kumo, indicating a bullish trend, below the Kumo, showing a bearish trend, or inside the Kumo, representing a neutral, undecided trend. Number 5, the Kumo versus the baseline and conversion line. The positions of baseline and conversion line are usually compared to the price, but their location versus the Kumo can be the indicator of the strength of the trend too. If these lines are located on the upside of the Kumo, it supports further bullish trend. The opposite supports the continuation of a bearish trend. Now let's analyze other components. First, the lagging span versus price. If the lagging span crosses up the price, it can be counted as a bullish sign, and vice versa for a bearish sign. If the price is on the upside of the Kumo and the lagging span crosses up, it's a very strong sign of the possibility of a long-term uptrend, while the opposite indicates a strong downtrend. If lagging span is inside the Kumo, the trend is undecided. Number 2, the baseline versus price. The baseline is behaving as a very strong support or resistance level, so it's a very important tool of identifying trend changes. We'll use it later in my multiple time frame strategy. If price crosses it up, this is a bullish sign, and if price crosses it down, that's a bearish sign. A bullish cross can happen above the Kumo, being a strong sign, inside the Kumo for a neutral sign, or below the Kumo as a weak sign, and vice versa for a bearish scenario. The distance between the price and the baseline is also important, as if price lives behind the baseline far away, it usually turns flat and attracts the price. This isn't necessarily a sign of the trend change. Number 3. Conversion line versus price. Conversion line is more sensitive to minor price movements, as it represents the momentum. However, it can be used as a trend confirmation tool too. For example, if price is in a trend, it usually creates waves and moves back through conversion line to the baseline, and then bounces into the direction of the trend again. Number 4. Lagging span versus baseline. Lagging span can be above, a bullish sign, or below the baseline, a bearish sign. As baseline is a very strong support and resistance level, as long as the lagging span is above it, the bullish movements are well supported. And if lagging span is staying below the baseline, the down movements are supported. It's very common to see the lagging span bouncing on the baseline before a huge move happens. Number 5. Conversion line versus baseline. A conversion line baseline crossover can also indicate the change or the continuation of the trend. An up crossover can happen above the Kumo for a strong signal, in the body of the Kumo for a neutral signal, or below the Kumo as a weak signal, and vice versa for a short scenario. Now let's face it, Ichimoku is somewhat complicated and clutters your chart. I personally simplified these rules. The description of an ideal bullish trend or confirmation would be: the price is above the Kumo, conversion line, and the baseline. The Kumo is thick and green, and the conversion line has crossed up the baseline above the Kumo. The picture of an ideal bearish trend would be: the price is below the Kumo, the conversion line, and the baseline. The Kumo is thick and bearish, and the conversion line has crossed down the baseline below the Kumo. This is a much simpler way to analyze Ichimoku, a faster way to spot a trend. All Ichimoku lines are support and resistance lines, however they don't have the same strength. Regarding the ideal bullish trend we've talked before, the strength order of the support levels would be: the bottom of the Kumo cloud as the strongest line of support, the top of the Kumo as the next strong line, the baseline, and then the conversion line as the weakest line of support. And for the ideal bearish trend, the strength order of the resistance levels would be: the top of the Kumo, the bottom of the Kumo, the baseline, and the conversion line. Choppy markets are the worst nightmare of most traders, but with Kumo cloud, ranging periods of the market can be filtered out with more success. If price moves into the body of the Kumo, it means the trend is undecided and the ranging period is probable. It's not recommended to enter into any position when price is moving inside a Kumo. The same applies to the lagging span. It doesn't matter if the price has already broken out from the Kumo. If the lagging span is still there, the ranging conditions are not gone yet. Now let me share how I perform a multiple time frame analysis using Ichimoku. A trend identified on the higher time frames can hold more strength than on the shorter time frames. For example, a Kumo breakout or a conversion baseline crossover is more relevant on higher time frames than on the shorter ones. The hardest thing for Ichimoku beginners is to create a valid basic analysis. For example, what if the price is under the Kumo, the lagging span is under the Kumo too, and the conversion is above the baseline on the 1 hour time frame? And which signals have more relevance? Also, what if the 4-hour charts are completely bearish, but the 5-minute charts are clearly bullish? That's why you need a multiple time frame analysis with a precise set of rules to filter noise and pick trends with potential. These are the minimum requirements that you should always check to be able to make a trading decision with Ichimoku. The price versus the Kumo, price position versus the baseline, and the Kumo color. Always check them in this order. If these parameters are the same on different time frames, then the trend has potential to continue. If you find that, for example, the conversion line and baseline are breaking out from the Kumo too, it can count as a bonus confirmation of the trend. The premise of this strategy is that you should always trade only in the direction of the higher time frames. I would advise to check at least 2 higher time frames. So if, for example, you want to enter on the 15 minutes time frame, you check the 1 hour and the 4-hour charts first. If you plan to enter on the 1 hour chart, then you check the 4-hour and the daily charts first. When checking the higher time frames, you check the previous 3 minimum requirements. Always start from the higher time frames and proceed to the lower time frames and never enter against the higher time frames. Use this checklist with your daily trading routine. If you have 3 conditions pointing into the same direction, you can move to the next lower time frame. If you have other 3 conditions pointing into the same direction again, you can go to your entry time frame. Here's my multiple time frame strategy using Ichimoku indicator. We go on the highest time frame, the 4-hour, and we check the trend conditions. Price is above the Kumo cloud. Price is above the baseline. And ideally, the Kumo cloud is green, but this is not mandatory on the highest time frame. Then, we go on the second time frame, the 1-hour, and we see price is above the Kumo cloud. Price is above the baseline, and the Kumo cloud must be green here. Then we move to the entry time frame, the 15-minute chart. Here, I remove all Ichimoku components and leave just the baseline, and I add the 200 exponential moving average. If the baseline is above the 200 EMA, then I take the trade in the direction indicated by the higher time frame, keeping in mind other support and resistance points on the chart. Stop loss goes on the other side of the 200 exponential moving average. And as an exit strategy, you aim for a 2-to-1 risk-reward ratio, and you monitor closely the 200 EMA and the baseline crossover. If the trend is strong, you can catch a giant move and exit on the opposite crossover. Here's another multiple time frame analysis, this time a more day trading approach. We move on the highest time frame, the 1-hour. Price is below the Kumo cloud. Price is below the baseline. And ideally, the Kumo cloud is red, but as I said before, this is not mandatory. Then, we go on the next time frame, the 30-minute time frame, and we see that the price is below the Kumo cloud. Price is below the baseline, and the Kumo is red. The trend is clearly down, so we go on the entry time frame, the 5-minute chart, and look for a short signal. We removed the other components to better visualize the chart. We add the 200 EMA, and we see that we already had a bearish crossover between the baseline and the 200 EMA. We entered short around this level with a 2-to-1 risk-reward ratio. The risk management here is very important. If you are lucky and the trend is strong, you can use a trailing stop based on the recent swings or the 200 EMA, and you can get a much higher risk-to-reward ratio. In my backtest, I've managed to catch an 8-to-1 risk-reward ratio. These are rare, but if things go your way, the profit potential is great. As always, if you got any value from this and learned something new, drop a like to help us with YouTube algorithm, and make sure you click the bell icon to stay in touch when new videos are released. Until next time.